Look, the week before when I started to trim, it was like, oh, how dare you, blah, blah, blah. And I'm like, well, I don't know if the smartest people are selling. Maybe it makes sense to sell. So I started to trim, and I'm so glad that I did, because it was, 10 days ahead or a week ahead of all of this craziness. Now look at what's happening in the markets today. People are going massively risk off. There are almost 500 stocks that are off 30 or 40% in the last 30 days.
Yeah.
But the stock market is still basically at all-time highs. So think of that for a second. So everybody that thinks that the stock market is doing poorly is wrong. It is doing exceptionally well. Elon Musk sold, 10 billion. I've sold almost, I think, $600 or $700 million worth of stuff this year. Like, this is what I think smart market participants do. You don't just wait and just try to mark to market the last tick. So everybody that thinks that the stock market is doing poorly is wrong. It is doing exceptionally well. It's just that the 400 stocks that people in Silicon Valley really care about have been getting kicked in the teeth.
Yeah.
And the paper company and the specialty chemicals company have actually done reasonably well, which
Airplane
are nothing,
parts and
which is nothing that any of us have exposure to, or some of us don't have exposure to. So go ahead, Jason.
Chamath, can we then look at this as, hey, the era of we're going to give a lot of credit to companies for what's going to happen in the next 10 years.
10-year outcomes. Yeah.
The 10-year outcome that we saw, Rivian came up, and then many other stocks, and obviously crypto falls into this. This idea of giving people a decade of forward-looking credit maybe is going to come back to,
I think it's too early.
Let's weigh these and look at earnings, or maybe 2 years of credit.
No, I'm not going to say that, because I think it's too early for us to sort of go and jump to these conclusions. Right now, we are in a moment. There have been 71 or 2 of these moments since 2009, where you have either a sector drawdown or a market drawdown. In this case, we're in the middle of a massive growth sector drawdown. Okay, the multiples on these companies are shrinking. Companies like Snowflake and
Peloton.
Cloudflare,
Zoom.
We're trading at 70 to 100 times revenue, and people are reevaluating whether those multiples are worth it, irrespective of the quality of the company, because those are very high quality companies. So we're just re-rating the risk right now, okay? And it's not broad-based. The real problem is all these companies that I think raised a lot of money in private markets are now going to get stuck, because if the public markets have compressed multiples by 30 to 50%, they are the ultimate buyer. The idea that you can wait and then go public later may not stand to reason, especially if inflation really keeps these multiples in check. We had this happen in 2018 because in 2018, it looked like there was going to be inflation. Powell, basically killed the market. He raised rates. And then it turned out he was completely wrong, and China was okay and everything was fine. And then the market just completely violently snapped back. Again, this is what I'm saying, which is it's too early to tell whether this is just a short-term opportunity for people who have made a lot of money to de-risk. And again, Satya Nadella just sold 300 million of stock.
Wasn't it half his position? It was half of his position. Yeah, I mean, that to me was significant.
Elon Musk sold, 10 billion. I've sold almost I think $600 or $700 million worth of stuff this year. Like, this is what I think smart market participants do. You don't just wait and just try to market the last tick. We focus on it a lot, but when we talk about the core structural economy, the stock market is a lagging indicator of a whole bunch of things. Sometimes it's cash flow. A lot of the times it's emotion.
Money supply.
I think that there's a much more important thing which we've talked about, which is that, we have said, and I have said, that coming out of the pandemic, we are moving the world back into a more, decentralized place, right? The centralization was this just-in-time, single supply chain, single point of failure existence. And if you look inside of China, the thing that they want more than anything else is to become even more centralized, right? I don't know if you saw today, but there was an article in the Wall Street Journal about how China is going to create basically an overall holding company to own all the rare earths that are made inside of China, and then to apportion them out as they see fit. So the government will now control a critical element and supply chain into climate change. Okay.
Basically, they're creating their own OPEC in a way, like their own version of.
It's a very good way of saying it. Exactly. So
Yeah.
so China is pushing more and more for centralization. So for example, myself and Fortress, we did this deal a year ago to bring this company public called MP Materials, and the whole idea was to start to build diversity in the supply chain, to build a decentralized supply of all kinds of things. In that case, it was around these rare earths because we saw this thing happening in China. Okay. The problem is those kinds of investments are very much few and far between. So the solution to fixing the core structural inflation we have is going to take a decade. It's going to take trillions of dollars of investment. And more than that, I think it's going to take an enormous amount of coordination between private and public participants. And I think that that's where this whole thing fails, which is why, I'm a little bit more concerned about it. And I think I've explained this to you, but look, we have massively underinvested in the level of infrastructure we need to support ourselves.
Yeah, we outsourced it.
As in a simple example, starting in 2016, we absolutely decapitated the ability for the United States to invest in our own true energy independence. Okay? The level of fracking, the level of nat gas, oil, all of this stuff basically fell off of a cliff. And you would say, well, that was the right capital allocation decision because of climate change. Well, it turns out today, not really, because we have absolutely no investments on the climate change side.
Right.
We don't have rare earths. We don't have lithium. We don't have nickel. We don't have cobalt. We don't have graphite. So we actually can't make the batteries, which means that now oil is at $100 a barrel and gas costs $10 at the pump. So that was a coordination problem. Really, the right thing to have done would have been to continue to invest in our domestic supply chain for energy, while we also created incentives to decarbonize. So this is what I mean by these issues have been building up for years, Jason.
Yeah, decades. Yeah.
Inflation is now here. I think it's here to last. I've been pretty consistent about this. And this is the real reason why we're going to have a few years of pain. And so money losing, unprofitable businesses selling future cash flows in 10 to 12 years. I mean, some people will buy them, but I won't.